Good afternoon, everyone. Welcome to our panel entitled What's Next on the Climate Front. Today we're going to be talking about what is next on the climate front and how industry impacted by these events are managing. We're going to hear from an excellent panel here about initiatives they have underway and, importantly, where these are moving forward. We're also trying to really highlight how the U.S. insurance regulatory community can be involved and engaged in these efforts. So speaking of that, I'm Jeff Czajkowski. I direct the Center for Insurance Policy and Research at the National Association of Insurance Commissioners, which climate and resiliency is a key regulatory initiative for the NAIC. This is due to the fact that what we continue to see is a large insurance protection gap related to natural catastrophe events, much of this falling on low income and socially vulnerable communities. Not only is there a protection gap in regards to homeowner property, but there's also currently a physical and social infrastructure investment gap that also has strong implications for vulnerable populations. In both of these points, I mean, we're recording this about a week or so after Hurricane Ian went through Southwest Florida, and both of these aspects are currently playing out there in terms of the protection gap and significant damages. And of course, the role of extreme weather under future climate will only exacerbate, these issues. So how can industry and regulators work together to make progress in this space, and really, what sort of tools and initiatives are available to address this? And we're trying to find out, where they're headed. So I'm very pleased to have our three panelists: Stacy Swan from Climate Finance Advisors, Stephen Rothstein from Ceres, and Suzanne Scatliff from AXA XL. And what we're going to do here is we're going to kind of walk through each of those in turn for them to touch upon sort of what they're engaged in and where they see things moving forward. So I'm going to first turn it over to Stacy from Climate Finance Advisors. And Stacy, if you wouldn't mind just kind of introducing yourself and your company and try to start to address some of the things that we just touched upon here in the introduction.
Sure thing. Thanks, Jeff, and thanks for having me on this panel. This issue is really important. It's super important in how we line up our kind of financial toolkit, I would say, in the immediate future and kind of 3, 5, 10 years from now, how we actually kind of get our hands around the climate-related financial risks, not just from an issue spotting perspective, but also from a actually solutions perspective, because you're right to point out the protection gap is wide and widening. And if we don't, as a collection of financial stakeholders and policymakers, come together to take care of this issue or kind of mine this issue, that gap will kind of become increasingly wider. So let me take a step back. I'm Stacy Swan. I'm the CEO of Climate Finance Advisors. We are a consulting firm that was founded in 2015. Our work is at the nexus of climate and finance. We are a collection of finance practitioners, bankers, private equity, investors, folks who work kind of on different types of financing, structuring, and policies and programs, and entirely on this climate issue. I will say that in 2015, when CFA was founded, primarily most of our work was around not just energy and renewable energy and the mitigation side of things, but really around kind of structuring funds. And then with the dawn of TCFD in 2017, we have really started to broaden ourselves out, because climate-related financial risk is something that all financial investors, no matter where you invest and how you invest, is something that's important for their investment decision-making. So since about 2017, 2018, we also do a lot of work on this issue of how to identify, assess, quantify, and then manage strategically climate-related financial risks. I will say, as it relates to insurance, I think a number of people still believe insurance is a risk solution. We still do a lot of work with people saying, no, actually insurance is risk transfer. You also need to reduce risk while you're also transferring risk. As an instrument, you all know from the insurance industry, insurance products are about transferring risk for a certain period of time for a fee in order to kind of help manage some of the risk that you might need to be managing and from a financial perspective. And I think that understanding is increasing, but it's really important as you pull climate and insurance together in a conversation, making sure people understand insurance mechanisms or risk transfer mechanisms. You also need to reduce risk, which is where, from a regulatory perspective, insurance regulators can play an important role as well. So taking a step back, setting the table, we know we've locked in enough warming at this point that even if we stopped emitting today, we still have increasing climate-related physical risks that we will need to manage. They're being realized today. We saw it last week with Hurricane Ian, and the intensity of some of those physical impacts is expected to increase even regardless of whether we're emitting more. We obviously know we have a lot to do to reduce emissions, but we still have a physical resilience climate risk issue at hand for all of our hard assets and a lot of our social infrastructure. With that increased warming, the climate impacts will increase, and these will result in financial impacts. When it comes to financial impacts, the ability for people to manage those does depend on whether they have access to affordable insurance to cover some of the hazards that they might need to be kind of managing around in the future. So this is kind of a big picture context. Every single part of the financial sector is starting to talk about this. And I give a lot of credit to TCFD for giving us a common language, regardless of whether you're thinking about TCFD as a disclosure or you're just an investor of different types trying to get your hands around it. But what happens with this better understanding of climate-related financial risks is that we might have a shift towards more climate-resilient assets. That's a good thing. There's the Inflation Reduction Act in the United States, I think, is going to be incredibly helpful for accelerating some investments on the climate side. But I think we also need to make sure that as investments, climate and clean energy investments are accelerated, we're also paying attention to physical resilience because that will help us as we're managing risks on the other side. Also, new business models and opportunities are going to come about and be invested in with a better understanding of this climate-related financial risk. And you're seeing this in the context of the data and analytics space, where climate-related data and analytics are kind of companies are kind of coming up over and over and over again and being developed kind of all the time. We're tracking more than 100 of them right now, and we're also seeing a number of those companies come together with different types of solutions for climate-related financial decision-making, which can be useful for thinking about how insurance is applied. But also with a better understanding of risk, obviously, is a potential for capital flight. And this is where this protection gap question becomes really important, because these are real challenges for certain types of vulnerable communities, certain types of communities where there's been underinvestment historically anyway. The acceleration of some of these climate-related risks and the increased awareness of risk from investors of all types might be a little bit of a perfect storm, which results in some of these areas actually having less access to finance, less access to investment, less access to affordable insurance, which can help them manage climate-related risks when they happen. So these are pretty important issues to be keeping your eye on from a community perspective, from a homeowner's perspective, from the kind of, a consumer purchaser of insurance perspective. We need to really start thinking about whether and how we can provide not just the affordable insurance underwriting that those communities need, but also the resilience measures that might come along with making them not just more resilient physically, but also more attractive underwriting kind of customers from an insurance perspective. The other thing is, so you have communities, you also have the resilient infrastructure investment that's going to be coming online. This idea that resilience has to be baked into how our different parts of our economy and infrastructure is done is at the top of mind of a lot of infrastructure investors. They're starting to ask the right questions about whether certain types of bridges, roads, transportation, energy infrastructure are also resilient is really important in terms of how those pieces of infrastructure are designed, and also will kind of result in, I think, better alignment of interests when it comes to thinking about the insurance needs for those types of assets. So that is kind of the context. Insurance is one of the regulated industries within the financial sector. You have sitting and at the federal level, you have a number of different regulators regulating different parts of listed equities and banking, but also insurance. And what's been nice to see in the last couple of years is some alignment among regulators that climate-related issues are important to be thought of within these regulated industries. And insurance is a key tool in the toolbox to help us start to figure this out. Insurance are among the world's largest long-term investors as well. So on the underwriting side, obviously they're on the front line of providing products to communities and individuals and homeowners, but also as an investor base. They're also a really important voice in terms of trying to push the resilience agenda through the things that they might invest in or the assets they might purchase as long-term investors. However, insurance as an industry is often constrained by regulations, which are very important, designed to guarantee insurers are sufficiently solvent when they have payout claims. That's something that has to be managed kind of as a regulatory issue. And if you start to believe that climate-related issues might accelerate some of those payouts or the frequency of some of those payouts, that's something that has to be managed from a solvency issue. And as a result, it might also have some restrictions in terms of, or it might result in fewer dollars being available for the investment on the long-term investor side of insurance portfolios. So those are kind of two competing internal kind of parts of the scale that are going to be important to be mindful of. National insurers' investment portfolios tend to be untapped when it comes to thinking about infrastructure and thinking about the different types of infrastructure investments that could be brought to bear. But insurers play a really important voice and have a really important voice in this conversation and could be potentially taking on a little bit of more of a kind of stronger role in pushing kind of resilience on the infrastructure side. So those are kind of interesting kind of things to think about when you think about insurance and the role that insurance can play. I also think investors who think of insurance as part of their solution, right? Investors are kind of putting in their debt or their equity into different types of assets, whether it's infrastructure or thinking about, even kind of community level assets. And they also want insurers to play a really important role in helping to not just be able to transfer those risks for a certain period of time from a financial perspective, but also play a really important role in helping to kind of push the resilience investments that are needed, right? If you can invest in something such that it is more resilient to the hazards you expect to be coming, then it's in everybody's self-interest. Obviously, if you take a homeowner, it's in the homeowner's self-interest to kind of be more resilient from a physical perspective. It's in the mortgage holder's self-interest that asset not be destroyed if a certain type of physical event comes around. But it's also in the insurer's interest to kind of make sure that asset is more resilient in those circumstances because their payouts are lower. So there's an alignment of interest there. And I think that there's some more work that can be done to bring some of these stakeholders together to move forward on kind of addressing climate-related resilience investments at all levels, at the community level and at the infrastructure level. And I think that that's something that's yet untapped. We are starting to see from some of our work, we're starting to see, obviously there's a lot of awareness on the investor side. There's a lot of understanding on the investor side. At the kind of consumer side or the homeowner side or the infrastructure asset developer side, that awareness is a little lower, but growing all the time. And then on the insurer's side, recognizing that most insurers tend to be pretty conservative in their approach to markets, having some ability to kind of unlock that really important role that they can play, both in promoting resilience and also kind of connecting up the conversation would be useful. I think I'll stop there because I'm excited to hear about some of the other speakers on the panel. I will just say TCFD as a concept has been incredibly valuable for creating this common language among different types of investors and different types of stakeholders around an asset, whether it's infrastructure or not. And I think that there's ways to start having the conversation such that insurers, as one of the most important signalers of risk in the market, can start to push and promote resilience in a more consistent way, and particularly on the physical risk side. And with that, I think I'll stop.
Why don't we, we'll come back after we hear from Stephen and Suzanne. So, and again, thank you for the mentioning of the TCFD and sort of your addressing this as providing a nice baseline understanding of what's transpiring. And so our next panelist here, Stephen Rothstein. Stephen, I know you've been involved on the TCFD aspect with the NAIC, providing some education for regulators around how to think through some of the TCFD responses. So why don't you maybe describe some of that, but I'm sure you want to talk about it a little bit more. But again, as we did with Stacy, maybe you could take a couple minutes at the beginning to introduce yourself to the audience, kind of talk about Ceres a little bit more broadly, and then transition into some of the TCFD work that you all are focused on.
Sure. Yeah, no, thank you. Thank you to the great work that you're doing and NAIC. Thanks to Commissioner Andrew Mays and everyone in Connecticut for your leadership, not just for hosting today's virtual conference, but for everything you're doing to educate insurance companies and individuals and taxpayers and legislators and everyone else, and to my fellow panelists for the great work that they're doing. So again, my name is Stephen Rothstein. I'm the managing director of the Ceres Accelerator for Sustainable Capital Markets. And Ceres has been around for over 30 years. And we do a variety of things, work with investors, companies, policymakers for investors. Our investors are collectively, it's about $60 trillion of assets under management, including a number of insurance companies, but some of the largest companies, BlackRock, State Street, Vanguard, investors, and others. And people come to us to help move their portfolio to be sustainable. That most investors today believe that that when they're in, the people who invest in their funds or their pension holders or retirees, when they want to get their money out, whether it's in 5 years or 50 years, that thinking about climate issues will help their return. It'll help in two ways. First, to address the risks that exist as investors and the opportunities. And as Stacy said, on the investment side of the house, that the insurers are a critical part of that. So there are some insurers, when you look at their investment portfolio, they're addressing climate issues and have set net zero plans, and some have not. We work with lots of big companies, policymakers in Washington and many state capitals, and then the financial markets per se. And the accelerator focuses a lot on the financial markets and boards of directors. We talk a lot about climate risk, and those are right with us every day. I've been doing this type of work for a while, and it used to be where you talk about it, this is a risk for your kids, your grandkids. Well, as we've seen from what's happening, this is a risk for us today. The storm that recently passed, while we don't have the final economic numbers, there are some studies that say it'll cost $50 to $60 billion. To put that in context, NOAA said for last year, take all of the climate events, the fires, the floods, and the storms, hurricanes, et cetera, from 21, that was $145 billion of loss, and that was higher than it had been in other years. And if this year one storm is 50 or 60, unfortunately, we're heading in a trend. There's a lot of cost. We've seen that in Florida, just with this, even before this recent example, their state legislature put up roughly $2 billion to further backstop their reinsurance industry because of the risks there. So this is a a climate issue, but it's really a financial issue as well on that. While climate is a critical issue, as I was saying, another one that we can't lose sight of is water. And I don't mean just a hurricane and flooding, the lack of water. That if we were on the other side of the country or in many parts of Europe or many parts of Asia, that we're seeing historic droughts, droughts that we haven't seen in 1,200 years, that there are many states now that they're on an allocation because of Lake Mead or others, where their water usage has been reduced by 20 or 30%. That's going to affect businesses, it's going to affect farmers, it's going to affect pricing, and that's going to grow. Obviously, water is a very precious resource, but it's also very local. So you could be in an area with a drought and 100 miles away, they could have it, but it doesn't really do much good. So we have a whole water initiative that if someone's interested, they could reach out to CERES.org, and we can share links as well. We have an investor network on this. We have companies that have been leading on these water areas, so that water and climate are both parallel challenges. The insurance industry, through the NAIC, has been collecting climate data for a while. They've just decided to replace the questionnaire with TCFD based, which is great. And again, I appreciate all the work that the comments that Stacey said about this, so that for many of you who are insurance companies, you're having to complete a TCFD report and submit it by November 30th. If you've already submitted it, that is great. If it's the first time, there are a lot of resources. They're on the CERES website and the NAIC website. We, for example, are sponsoring 10 hours of interactive discussions. 6 have occurred so far, and the other 4 are happening later this month. And I will again share the link with our colleagues in Connecticut for them to share with you. But that is a first look at some of the portfolios. TCFD will ask every company, including the insurance company, to what are the key issues in governance, what are the key issues in strategy, in milestones and other key areas. And it's been used now by over 3,000 companies. There are 8 countries that require it. Plus, it's estimated that somewhere around 400 insurance companies will be completing it. So that's an important step that we're happy to work on. I guess the other thing I'll just say before Jeff turn it back to you, and I'm happy to provide more background on any of this, is while at the parallel level, it's important to keep in mind that the Securities and Exchange Commission, they're currently considering a climate disclosure rule. So as many of you on this webinar know, they issued a proposed rule in March. They collected comments through June. They got over 14,000 comments. 80% of that comments were positive, not unanimously positive on every element, but generally directionally positive, but very strong on both sides. There are very strong opinions of people saying this goes too far for the SEC, either the broad issue or some of the specific areas. So the SEC is right now in the midst of considering this. It is likely they will have a final rule late this year, early next year. That obviously will only affect the publicly traded companies, so a small percentage of those who are watching now, but it'll also set a benchmark for others. So that's an important element. And they also have used TCFD as a basis. So one of the key things is to have as much alignment as possible. And I know that the international groups, the International Sustainability Standards Boards and others, and then the national groups like the SEC are just as NAIC did with its work. So Jeff, let me turn it back to you, and I'm happy to talk more about that or the other research we're doing.
Thank you, Stephen. And yes, I think we'll come back here after Suzanne has a chance to walk through her comments. I did have a couple of follow-ups with you as well, and it is interesting to see. You didn't dive into the details on this, but on the water initiative, I'm kind of curious around the overlap around water infrastructure, or maybe some of the stuff that, Stacy had highlighted, but we can come back to that, that she had highlighted on the infrastructure side. So, but our last panelist here is Suzanne Scatliff from AXA XL. And Suzanne, we just heard from Stephen around TCFD. But of course, that's not the only disclosure that's making its way into the finance and insurance sector. So maybe you could talk a little bit about TNFD.
Yeah, of course. Thank you, Jeff. Happy to. I do have a few slides, so I'm just going to share those now. So thank you, everybody, for allowing me to join your panel today. I'm Suzanne Scatliff. I'm the Global Sustainability Director at AXA XL. We are the Property, Casualty and Specialty Risk Division of AXA Group, providing commercial insurance and reinsurance products globally. I'm going to talk to you today about nature-related risks and reporting. Both AXA XL and the wider AXA Group are quite heavily involved in looking at nature protection, but also the resilience benefits that nature provides us, which of course is very material to us as an insurer. So I'll start a little bit with some context as to, firstly, why it's critical that we start to consider the economic value of nature more deeply. I'll talk a little bit about the work that AXA XL have already been doing, and then I'll focus more on the emerging nature risks framework that's been developed by the Task Force for Nature-Related Financial Disclosures, or the TNFD. So to begin with, in terms of why we need to value nature, so we know that nature brings enormous value across supply chains and operations, as well as obviously providing many significant benefits to wider society. But to date, we haven't been great as a world in terms of actually putting the financial value on nature. That being said, there have been some recent studies. So I wanted to share with you a very recent study actually that was released just a couple of weeks ago from Moody's, which states that almost $1.9 trillion is at stake as biodiversity loss intensifies nature-related risks, which is just staggering, obviously. And although financial markets are currently under some strain at the moment, and perhaps biodiversity isn't immediately top of mind, Moody's states in their report that the long-term ramifications of a compromised natural world are significantly quite devastating. We can also see here that certain ecosystems or certain pollinators, for example, have an enormous role to play. And actually, if we see them significantly depleted, it's going to cost the world a significant amount of money. So if we lose our pollinators, you can see here an EU-funded study suggests it would cost us around 153 billion euros. And then very significantly for us, again, as an insurer, is looking at actually the green infrastructure that we have and the value that that provides. So mangroves, which we are very passionate about at AXA XL, as I'll share more shortly, provide huge flood resilience benefits. If we lost our mangroves, we'd be looking at a real significant amount of property damage, but also a compromise to communities who depend on coastal health in order to live and in terms of their livelihoods. This statistic here states that if we would see an annual loss of $65 billion if we lost all of our mangroves. And at the moment, they're currently protecting more than 15 million people. So pretty significant. I wanted to share a little bit now about the work that we've been doing so far in terms of valuing nature before getting on to the TNFD. So we've had a long commitment to focusing on nature protection and that intersection with risk and resilience, as I mentioned. We've had a particular focus on ocean research, and we were really pleased to launch at COP26 last year our Coastal Risk Index, which is a tool which essentially shows the value of ecosystems. So we can see current and future flood hazards, but also the role that coastal ecosystems play in a way to start valuing the benefits of these natural solutions. We're also working with the Nature Conservancy to look at how we can quantify the resilience benefits of coastal wetlands. The concept essentially is that we would develop a resilience credit, a little similar to a carbon credit, but essentially it would quantify the flood resilience benefits of a mangrove, for example. So investors could purchase this with a carbon credit or separate too. And then I was pleased to hear Steve talk about water. That's certainly something we're passionate about too. We do believe that water-related risks are undervalued and underappreciated. And so in 2020, we launched our Valuing Water program, which looks at how we can help our clients and wider businesses and communities really identify and mitigate a range of water-related risks and consider the economic value of water as well as the social value. In addition, we also have a number of investment and underwriting guidelines, particularly focused on deforestation and World Heritage sites, really to think about how we protect these ecosystems and also prevent any kind of further damage or compromise to the value that they provide to us as a society. So I said I'd talk a little bit about the TNFD. The reason why I'm here talking about the TNFD is actually ACS has been a founding member and a very active supporter of the development of this disclosure and framework. Some folks may be aware that the TNFD is very much a global initiative. It's cross-industry. So there are a number of businesses involved. You'll see here on that third bullet point, some very significant companies and brands who are helping really build this out as a reporting framework, but also as a tool really for us all to better identify our nature-related risks and opportunities. The final recommendations are expected in September 2023, but there are a number of iterations, 2 of which have already been released. The next one is due around November time, and then the 4th version will be following hopefully in February. So you'll see here at the bottom of the slide, the first version essentially has focused on concepts and definitions, and I'll talk a little bit more about definitions shortly. It also includes some initial guidance for corporates to assess their nature-related risks, and also the draft disclosure recommendations, which are a little similar to the TCFD, and we'll look a bit more at that shortly. The second version builds upon what we saw in version 1, but it also includes a draft of metrics and targets, which of course is one of the key challenges when we're thinking about the quantification of nature, but imperative that we get it right. It also includes specific guidance, and that's both from a sector-specific side of things, as well as specific guidance related to certain elements of nature, which obviously will be more or less material according to the industry that the report is being provided from. So I said I'd talk a little bit about definitions. So we need to start obviously with the definition of nature itself. The TNFD has decided to use IPBES as the kind of guiding definition, which you can see here. But I also just wanted to highlight that for the TNFD, the fundamental concept is that people and societies interact with nature and cannot be considered as being separate from that. So a lot of what you see here, particularly on this diagram, but also throughout the framework, keeps that top of mind. The TNFD believes that nature can be understood through 4 realms: land, ocean, freshwater, and atmosphere. These are obviously major components of the natural world, but can be a little bit different in terms of their organization and their function. And you'll see that atmosphere here is included, but in a slightly different lens. That's really to kind of highlight the climate and nature nexus, and really acknowledging that climate mitigation and adaptation occurs across all of the realms. In addition, we also have definitions of nature-related risks, which I'm not sure how clear the slide is. I know there's quite a lot of text here. Hopefully we can make these slides available afterwards as well. So for those who've maybe gone through TCFD, you will probably recognize the first 2 categories, physical risk and transition risk, and I've probably been thinking about these through a climate lens. The proposal now is that we think about this through a nature lens. You'll also see systemic risk. So systemic risk essentially is looking at how we think about all of these things coming together. So actually, how can physical risk and transition risk potentially collide and cause a chain of consequences? So this isn't just about individual factors, it's actually thinking about a range of things coming together that could cause a systemic impact, either on supply chains or on operations. In addition, the TNFD have also included something very similar in terms of nature-related opportunities. For the sake of time, I won't share that today, but this is all available on the TNFD framework website, which I'll share at the end of the deck. So I wanted to just close now with the disclosure recommendations themselves. As I mentioned, for those who have been through TCFD or are familiar with the framework, you will recognize these 4 buckets certainly, and some of the structure is quite similar as well. So governance essentially is looking at organizational oversight. Again, as per the TCFD, that's both thinking about the management role, but also how the boards are involved in governing nature-related risk and opportunity. On the strategy side, we're looking at how nature-related risks and opportunities impact business model, strategy, and financial planning. Risk management, again, very similar to TCFD, looks at how nature-related risks are built into overall risk management approaches. And metrics and targets looks at key performance indicators related to nature-related risks and also opportunities based on nature dependencies, which the TNFD essentially identifies how an organization is reliant on a particular ecosystem or a particular element of nature, as well as nature impacts. So this is guidance for all sectors, but we do expect specific guidance for individual sectors to follow in due course, the same as the TCFD, where we have sector-specific guidance for these 4 elements as well. And the idea is that preparers should really be thinking about what's material, and that should be based on an assessment of nature-related dependencies and nature impacts. They should be considering how their organization interacts and interfaces with nature at specific locations. They should be thinking about how the correct skills and competencies are available to assess nature-related risks, and also should include a statement regarding the scope of current disclosures and what further disclosures might be planned in the future. So for those, again, who are familiar with the TCFD, I'm sure you know that originally it was developed as a voluntary framework, but actually we're seeing a number of jurisdictions adopt this as part of their own regulatory requirements. From a corporate perspective, I would say having this consistent approach can be very helpful. It enables us to focus on developing very detailed and robust, but also very focused reporting. Hopefully there is an opportunity for regulators to consider how the TNFD recommendations could be adopted in a similar manner. Of course, the final recommendations are yet to come, and we'll see further iterations, as I mentioned, over the next 6 months or so. So to close, a lot of the diagrams and the content I've shared today is all available publicly at this website address. The iterations that I mentioned will also be added in due course. So I'd recommend anybody who's not yet familiar with the TNFD to take a look. It's very user-friendly, and it's a great way for being prepared for what's coming down the track when it comes to valuing nature. Thank you for listening.
Thank you, Suzanne. One sort of quick follow-up for you, and then maybe I'll pose something to the rest of the panel. You know, I appreciate that you connected back to the TCFD in kind of how you think about the TNFD, right, and the similarities there. I guess I'm curious, what has sort of been the insurance sector's engagement here? And I you know, as Stephen had mentioned too, I mean, recently within the NAIC, they've moved to, you know, this sort of TCFD overlap, and that was quite a bit of a process to kind of move through that. So I'm just trying to think, you know, as you think about TNFD and, you know, what the insurance sector engagement is here, and how should maybe regulators, particularly in the U.S., be thinking about this new disclosure framework?
So, I mean, from an insurer's perspective, obviously, I can speak for AXA XL. I do know that a number of our peers have already produced TCFD reports, though. So, I think for us, we consider the TCFD framework to be a very useful tool. There are still elements of it that need to be developed further for the respondents. So, I think, you know, one of the tricky parts is on the metrics and target side. I think many carriers, including ourselves, have managed to develop a approach to calculating our carbon footprint from an operational perspective. There is now work underway for us to think about that on the underwriting portfolio side. So actually, how do we develop a decarbonisation pathway for underwriting? And the audience might be aware that the Net Zero Insurance Alliance is essentially a consortium that is working on that complex but important problem now to help carriers have better methodologies to work through that challenge.
Thank you, Suzanne. So a question for everyone, and you can figure out who wants to answer first. But I mean, you all essentially highlighted a number of tools and frameworks that are applicable or currently being used, and really, from my perspective, a lot of these are fairly new. So I'm just wondering, kind of, what are you seeing in the application of these tools or frameworks? And in particular, what is it that you're seeing or learning that would be, especially relevant for regulators in the U.S. to be thinking about?
Do you want me to start? I'm happy to.
Absolutely. Go ahead, please, Stacey.
Sure. So one of the things I think that's important to state is that TCFD and potentially TNFD and the kind of efforts around disclosure are really about solving an information asymmetry problem. And one of the kind of groundbreaking things that TCFD has done, I mentioned, is this common language, but it's also been a nice framework for entities, whether you're an insurance company or a business, or a corporation, to start getting your hands around climate-related risks, because you can't actually disclose anything that you haven't worked through. And this paradigm that they have, governance, strategy, risk management, and metrics, is a nice way to break down kind of how do we actually, I'll put myself in the kind of position of an entity that might be regulated by an insurance regulator. How do I, as an insurance company, understand how I'm governing around climate-related risks, what my risk management is around climate-related risks, and from there, the different hazards that I might be underwriting, what my metrics and targets are around measuring and monitoring those risks on an ongoing basis, and how that might feed into my strategy, my business strategy, my market strategy, the customers I serve strategy. So that framework has given people the ability to start rolling up their sleeves and figuring out how to identify, assess, and quantify risks that they might have that are of a climate nature. From a regulator's perspective, the disclosure is really important so that a regulator can understand the systemic exposure that the collection of entities that you're regulating might have to certain kinds of climate risks. But disclosure and reporting is only one part of the financial system governance body's toolkit, right? From a federal level, the financial system governance bodies are policymakers, they're rulemakers and standards bodies, and they're oversight and supervisory bodies. And they do not just disclosure, but they also do fiscal and monetary policy. They also do prudential kind of management, and they also do standard setting. So the disclosure among insurance companies to essentially disclose to regulators this, let's call it health check of what kind of climate-related risks they might have, will be useful for regulators to then also start to plan how they might adjust to certain types of things. And by the way, this issue of the protection gap is a very important public policy issue, because if we do not have kind of the tools to help the folks who are most vulnerable, and I don't mean just the physical tools to help them build in resilience, but also the financial tools like insurance, all this comes back to the public balance sheet anyway. So from a policymaker's perspective and from a regulator's perspective, that information that you get from the disclosure is important to help inform how you're going to help address market issues, market failures, potentially think about how that protection gap needs to be served. There's some very difficult, from a physical climate risk perspective, there's some very difficult public policy questions on the horizon. Fort Myers is kind of our latest example of a big acute disaster where we have at some point, not that far in the future, to think about rebuilding. And the whether and how to rebuild is an important public policy question if there's no financial support for that. So from a big picture perspective, the regulators kind of should be looking at TCFD as a way to get information for them to do their jobs around, policy making, rulemaking, standard setting, oversight and the like, because this can be a systemic issue. And then I'll just say, as it relates to the nature side of things, the industry has perceived climate-related risks to be very asset-based, but actually part of our resilience is the nature that we protect. And those tend to be very public policy, objectives as well. I mean, you save a mangrove or you protect the Chesapeake Bay. I'm sitting in Washington. You protect the Chesapeake Bay in order to protect the communities upstream, right? And so these are all part of a kind of comprehensive way of building in resilience, for all of us.
Stephen, I'd like to pass it to you on this because maybe I don't know if you were going to go here based on Stacy's response, but yes, I mean, I would agree there's a lot of information there, but I think even some of our own work, the challenge is how do you work through all of that information? And I know Ceres is involved in, it's sort of an initiative around that, but maybe you were going to speak to that, but I would kind of pose that question to you from that, that perspective.
Sure. Yeah. Let me get to that in just a second. First, I agree with everything that Stacy said. And for a company that's doing it for the first time, two things. I wouldn't let the perfect get in the way of the good, meaning you're not going to have good information. And I've read now several companies, not insurers, who have filed TCFD 3-4 years. And the reality is every year it gets better because their systems get better. And the first year they may not have a committee to address this. They may not be collecting information, and next year they do. So don't let the don't let it get in your way. The second thing is that we all, as in whatever business we're in, we can't manage any problem if we can't first measure it. So, but measuring it does not mean managing it, meaning disclosure is critical. And as you mentioned earlier about the asymmetry of information, we have to make sure that investors, whether those investors are insurance companies or others, have that information, but also that these are public, and this is for employees. 74% of employees want to work in a place that upholds their values. Every company, whether you're an insurer or in any industry, we're all looking for employees at this stage of the marketplace, so that's important as well. So it is a critical element, but it's just the first element. The second element is then to develop a plan to reduce exposure, reduce admission. One of the things that we're doing with California Insurance Commissioner, NAIC, and others is to do an analysis of machine learning. So it's impossible to have a human being read all of the TCFD reports and then to do a summary of those, just in terms of bandwidth. But what we do have is a company based in Europe, but they're focused on natural language, the machine learning. And so we've analyzed all of the 21 TCFD reports in the final stage of the review now, and analyze them to see who has specific recommendations, which ones are more general. And it's not going to grade them, but at least there'll be some information that'll be available on the Ceres website and California and others. So that's an effort that is going on, and that's likely to be expanded with the 400 that'll be submitted on November 30th. So back to you, Jeff.
Yeah, no, thank you, Stephen. I mean, that's kind of what I was getting at in my question there, and I would agree. I mean, I think it's very difficult to work through all that information, right? And so, maybe this is sort of the next phase in the climate front. I don't know, is trying to, first it's collecting the information, but then trying to develop tools or other aspects that can kind of help work through that a bit more effectively and efficiently to try to, Stacy, to your point, to make some policy or regulations around that. Suzanne, I don't know if you had a comment on any of the tools aspects. I mean, you did mention the coastal risk index or other things related to the TNFD, but I'm just curious, is anything that you're seeing on the tool side or what you're learning from the implementation of these?
I mean, I think climate tools are relatively mature compared to nature. That's the key challenge, obviously, that we're seeing now is that, nature still feels very nebulous. There's been some interesting academic papers produced by NGOs, by governments, in terms of how we need to rethink GDP, for example. But what we need now is something that's translatable from a corporate perspective. Some of the statistics I shared, obviously, are those kind of global macro level. But actually what we now really need to get down to is, rather than the global impact of mangroves, actually, what about this particular mangrove forest in Miami? How do we quantify the financial benefits of that? What are the financial risks if we lose that particular mangrove forest? So that's the next frontier for us, is actually taking a more granular approach to how we value nature, and then building that into products and pricing, and also helping our clients better understand the fragility of their supply chains. I think we've seen that to some degree with things like the global pandemic and the impact that climate is already making, but that will continue to happen. And we need to get really smarter as a world in terms of how we value nature, and think about it in the same way that we do some of our other commodities.
Yeah, I think that's a good point, and reminds me of there's been some work through the IAIS and their GMAR report. I can't remember their exact acronym on that, the Global Monitoring Assessment Report that they have for the insurance sector. And they had ran a climate transition risk analysis, but it was a sort of a global framework methodology that they had proposed. And so as even we've started to think about that, and maybe getting that more granular, like you are stating, Suzanne, down to sort of the U.S. level, some of these methodologies that work from a global perspective might not translate necessarily as you move into the more granular aspects. I think that's it's kind of a good point. So I'm going to turn it over to my panelists if they have any final thoughts or comments before we close.
Yeah, Jeff, actually, I was going to chime in on your last question about what to do with all this information from your perspective, right? So this information is going to come fast, and it will be really useful for you to think about how as a regulator that affects kind of your own little system that you're managing. And that you're kind of minding as a regulator, but kind of taking it one step further, which is where I think kind of saw, this protection gap issue is, but also potentially how a better understanding of climate-related risk can lead to certain incentives in the system, right? So if you can have this disclosure, you can have this information, you understand how this might start to affect kind of the entities that you regulate, then you can start to say, well, what are the things that we might need to put into the policy-making body, the financial policy-making bodies to, incentivize climate resilience, for example. One thing that insurance companies do in other parts of the world is they are starting to price around this resilience. So your risk-adjusted cost of insurance, again, for certain types of coverage, certain types of hazards, can be differentiated if you as a purchaser of that insurance are doing the right things to become more resilient. We haven't in this country made those connections yet, but it could be actually quite important, particularly thinking about Fort Myers and how we rebuild after Fort Myers. If we do, what types of rebuilding? Certainly the current standards may not be sufficient, right, for that particular piece of land and geography. But the other thing that insurance can do, if not pricing and incentives for resilience, it can also potentially start to discourage maladaptation. And that's also part of insurance's DNA. It already does risk-adjusted costs and pricing, but I think that because insurance companies are just starting to figure out and get their hands around some of these risks, maybe we're not seeing as much of that maladaptation kind of question as well. But I think that's kind of maybe for another panel or another session.
No, as an economist, I certainly appreciate your comments around incentives. So thank you for those closing thoughts. Stephen.
Yeah, I mean, there's a lot been said that I think bears repeating. I will add one other point that was briefly alluded to or mentioned before by Stacy, is that, well, this affects all of us in society. It affects mostly, more directly, those of our neighbors that are low and moderate income. And we have to have specific projects and specific products to meet those needs. I'll turn it back to you in the interest of time.
Suzanne, any final comments or closing thoughts?
I guess maybe I would just add that I think, we're probably more aware than ever how interconnected our world is. And I think we need to continue to think that way, particularly with both policymakers and the private sector. I think, with, again, staying on nature, we've got an enormous opportunity to be smarter about how we think about natural capital. We need to move as a world from thinking about it being free and infinite to actually being limited and expensive. And I think, we've all got a role to play together, both policymakers, private sector, public sector, society at large, in making sure that actually we get smarter, quicker about how we actually value nature.
Well, thank you very much to all of our panelists. I mean, I think that, sort of this notion of awareness, or the fact that, and I can't remember which one of you said this, but all these tools that are being developed, and they're really sort of in their infancy, relatively speaking. And so, it'd be interesting, it's going to be interesting to see how these continue to evolve, and maybe we'll come back next year and talk about that. So thank you very much for your participation.
Thank you, Jeff, and thanks to the folks in Connecticut.